Mixed market closes on Friday. Joining us, Alan Brugler with Brugler Marketing and Analysis. And Alan, let's talk a little bit about, we started off the week in the grains with the big uptick on Monday reacting to the report, but then kind of got caught up in money flow and macroeconomic concerns the end of the week, didn't we?
Yeah, I think that was a big part of the sell-off. You have a certain what we call a battering trade, a battering ram trade, where you have the big surprise news, you run all, in this case, the weak shorts out of the market, and then you spend the rest of the week taking profits if you happen to be lucky enough to be in on that early rally. I'm talking from a speculator standpoint. The macro side of things is a concern. If the Fed's raising rates and trying to provoke a slowdown, soft landing, or recession, depends on who you're talking to, how far it goes, uh, that will hurt some commodities more than others. We still have negative real interest rates, so there's still an inflationary aspect to this as well.
So next week, we kind of trade that all the way into the Fed announcement on Thursday, you think?
Yeah, I think we're still trading the seasonality. The reality is we've got 14 to 15 billion bushels of corn that's all going to hit the market in a 30-day window. We need to build some carry in the market to allocate that supply over time. Same thing with the soybeans, except we're only talking 4 billion plus. Uh, that's why the market typically has a little pressure in the front end. The but yeah, the macro money is going to be concentrating on what the Fed's doing.
So how much do you think, as we go into harvest, the downside risk is here? How much will we consolidate off of these highs that we scored on Monday?
Well, we had some pretty good support there on Friday. We went down to the 100-day average in the corn. We went down to the 18-day average in the soybeans. I think there is definitely risk lower. I mean, you could certainly go back to $14 on beans if you have some harvest pressure here and don't have the fund buying to offset it. Uh, we know that on the corn side, the export sales are pretty poor. We're over 12 million metric tons behind year-ago on corn export sales. At some point, the market may have to drop just to get that business on the books. Most of that won't be till December, January shipment, however.
So corn, as you point out, we don't really look competitive right now. Is that true of all of our grains or not?
Uh, to some degree. The soybeans, we have a nice forward book at about 3 million tons ahead of a year ago. But as you're probably aware, Argentina created an artificial currency exchange rate, the soy dollar, in order to get more Argentine farmers to sell their beans because they need the foreign exchange. They need to get the dollars from those exports. China has taken advantage of that and is buying a lot of Argentine beans right now. They're not putting as much on the U.S. books as we would normally expect for this time of the year.
So how much Argentina soybean crop has been sold and how much more is going to come onto the market?
Well, they kind of use the beans as a bank account, but because they have 70% inflation down there, 70%. It generally pays to keep the beans in the bin until you actually need the money. There's actually quite a bit of supply because they only harvested back in April and May. So there's a lot of the crop is still there. But again, the government is trying to stimulate the sales. Some of the estimates are that 3 or 4 million tons got sold just in the first week after that exchange rate modification.
Wow. So soybeans on Friday also kind of got caught up in the tug of war between soybean oil going up and soybean meal going down, didn't they?
Yeah, and that oil meal spread has been very volatile this week. You've seen a couple of days with big gains in the meal. You've seen again, like on Friday, you saw a move in the oil, but the meal pulled back. The bottom line is board crush margins, which is where you're buying the beans and selling the meal and selling the oil, are very attractive. Okay, the processors can lock in very attractive prices. They just have to go out and buy the cash beans at that point. So whether it's oil or meal lead right at the moment, it's still attractive to process beans.
So we hit some, I think, 2-month highs here in parts of the wheat complex this week. So has that been technical or is there other things that are driving that?
Well, we've argued that we've been in a basing period here. Rather than have a single harvest low, we've kind of consolidated, had a 60-day trading range. We're trying to break out of that to the upside. Fundamentally, I think it's post-harvest. It's also questions about the Ukrainian export corridor and how much wheat is actually going to move out of there. The world is counting on some of that supply leaking through. It's also looking for increased exports out of Russia, and it looks like we're starting to get those. So that's kind of dampening the rally. But again, the U.S. is a source. We've got good quality wheat to sell, and I think technically we could easily see a 50 or 60 cent bounce here. I won't put a calendar date on when it happens.
So what do you see for winter wheat planting? It's dry in a lot of areas, but it looks like the base price for insurance is pretty good. What do we do?
Well, I think you plant it wherever you think you've got enough moisture to get it up, and you get a little rainstorm, the planters will be running in those areas right away. Some people, of course, have different soil types and can go ahead and, as the old saying says, plant in the dust and your bins will bust.
So are we
So I think
planting for
we're going to try it.
insurance though?
Uh, I don't know that we're planning for insurance, but it's helpful that the insurance level is where it is. You know, again, it's not uncommon to have to plant into dry soils for winter wheat. Uh, I don't. I know there's some areas that there's just not enough moisture there to get it to emerge, and the guys have to wait there.
You bet. So cattle market setting back here today, we ran into a little that same chart resistance we keep running into, but we did have some better cash trade. So as we go forward with this tug of war, what wins out here?
Well, we know in the long run, given where we are in the cattle cycle, cattle numbers are going to decline, and ready cattle numbers, what's available for the packer to buy will eventually decline. That number's been propped up by the number of heifers that we've been putting into the feedlot. Beef production's also been propped up a little bit by cow slaughter and beef imports, but the beef imports have slowed down, and so has the cow slaughter. So all that points towards tighter beef supplies, fourth quarter or first quarter of next year. So the tendency over time is for cash cattle to go up. We're going to get these weeks where the board gets ahead of the cash and has to back off, or potentially some consumer demand issues if we really get into a recessionary environment. But over the long haul, the direction is up until we get interested in raising more mama cows and getting more steers.
All right. Well, I appreciate your analysis as always. Alan Brugler joining us with Brugler Marketing.